Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at three big reasons why Avis Budget Group, CAR, is looking finally like a short as the stock continues to get squeezed to ad infinitum. And we're looking at a very long term sell strangle like we have in the past on a lot of these stocks that have seen a huge run up in the stock price along with a huge run up in implied volatility. So able to hopefully capture both at the same time. As we always like to do, we take a fusion approach with a look at fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, here's from Thursday. We were closed on Friday for Good Friday, but Thursday's scanner, right, identified Avis Budget Group, right, near the top of the list with over 16,000 contracts trading, more than double, in essence, the normal volume. You see implied volatility jumped almost 20%, trading at back then the highest level we had seen over the past year. This kind of piqued our interest, but we waited until today because we saw more and more volume coming in, and the implied volatility, as we'll see in a second, shoot higher and higher. From a fundamental perspective, last earnings they missed. The stock was downgraded, traded down under $100, right, with a big earnings miss, right? They lost money. But since then, the stock has moved basically up 150% from 100 to 250-ish where it's at right now. So certainly a rocking ride here over the past couple weeks. But valuations, as expected, here's price to sales, but the only metric that has a clean look at it right now, trading at by far the highest level of the year, as you can see. So a huge spike. So this is not a fundamentally driven rally at all, as we'll see in a second. We always like to look, as we said, at that technical perspective as well. So here's a 1-year chart on the Avis Budget Group, right? You can see the stock was trading under 100 not too long ago, but you see this just huge parabolic move right higher, right? The stock has really only had one minor down day, right, over the past 2.5 weeks or so, trading at the biggest premium to the 20-day moving average we have seen, maybe perhaps ever, but certainly over the past year by far. 9-day RSI now over 90, also at the highest level of the year. A MACD reaching extremes as well. Bollinger percent B, even with the huge jump in implied volatility, what you see. And remember, Bollinger percent B is implied volatility based, trading well over 100 as well. So all the technical indicators pointing to a hugely overbought stock. Where it stops, when it stops, is the $1,000,000 question. But we'll see in a second. We're going as long term as you can to give ourselves plenty of time for the inevitable return to sanity, both from implied volatility and from price perspective. And here's the implied volatility chart, a generalized one. As you can see, by far the highest level over the past year. So option prices have skyrocketed along with the stock price because of the short squeeze out there, right? Not at all fundamentally driven. As we said, earnings, last quarter were a huge miss, right? So it's been a choppy road, to say the least, for Avis Budget, but the squeeze is going. And the best way to play it right, I think, is to go as long term as possible, because trying to time it right is very difficult. You know the insanity will stop. You just don't know when and how high. So certainly the fundamentals looking like this stock is absolutely overvalued. The technicals at extremes as well. And as we'll see in a second here, implied volatility also at ridiculous extremes. So I pulled off a series of implied volatility. This is basically from Fridays when the first, unusual option activity hit. You can see here is a longer term 120-day IV chart, just skyrocketing, right? You can see the vol surface lifted across the whole term structure. You can see not too long ago, right, towards the end of March, right, IV was kind of hugging that mid 50-ish level. Then we saw some unusual, and then on Thursday we saw that first wave coming in, moving IV from basically 80, which was rather high in comparison, to almost 100. You can see the whole term structure lifting huge. Now IV percentile at the 92 percentile. Taking a look, here is a 360-day, basically 40 delta call over a 2-year period. You can see approaching, this was on Friday, right, the highest levels we have seen over the past 2 years. Both those times were peaks, right, not only in stock price, but in implied volatility, with IV caving as well. This time we'll see, but it certainly was approaching, and that piqued our interest. Here is a kind of 6-month look at that. You can see it had been kind of mired right around, as we said, that 50-ish level, now exploding much higher on the 360-day. The 60-day 40 delta call option, the same sort of thing here, actually exceeding it. So the shorter term IV getting extremely rich as well, right? Here's a 6-month look at it. You can see again that explosion because of that unusual option activity. Fast forward now to Monday, and I pulled off a 60-day IV. You can see it went even higher, right? The whole term structure vol lifted again, right? The previous in red to Monday's close here. You can see on Monday, IV now over 115, right? On the short term, you can see the entire spectrum lifted dramatically. IV percentile, obviously at the 100%, in other words, options have not been this expensive. Here's a look at it right here. You can see the 60-day exploded to the highest level over the past 2 years. On a shorter term basis, you can see that or on a 360-day basis, right, also exploding to the highest level over the past 2 years. So option prices getting very expensive. This huge run up in IV means option prices getting really expensive. So we are waiting to pull the trigger. Today was the day we actually jumped in and did it lightly. Here I pulled off today's IV again, going to the 120-day IV. You can see just ripping higher, new highs here, by far the highest level over the past year. The whole term structure lifted once again. Here you can see on a shorter term basis, right, IV now over 160 because of the short squeeze and huge volume that continues to flow in. Here's the volume on the options, as you can see here. So just a mass panic, everyone racing in to play the short squeeze. We think it's absolutely probably getting overdone. Obviously, this kind of move in IV cannot last too long. We can see here is the 2-year chart of the 60-day 40 delta call, absolutely exploding to the highest level by far over the past 2 years. This kind of move doesn't last very long, so we don't mind selling into that. We liked and elected to go longer term, so the 360-day pushing towards 100, right, just trouncing the previous 2 highs, which were met with an immediate reversion in IV. So certainly IV has reached a extreme, to say the least, price action, and extreme, to say the least, valuations for what they're worth, and extreme as well. So it sets up ideally for a longer term January of 2028 sell strangle. So kind of walk through that. I pulled off initially, right, going back to July 25th, the last time that we saw Avis back at this same price was back here, right? So I pulled off the July 25th data and compared it to, in essence, Thursday's close. So the July 25th with, a very long time to go. These are December of 2027 options, right? 875 days to go. So more than 2 years, right? That 150 270 strangle, selling the 150 put, the 270 call, right, which is basically 50 plus points out of the money on both sides, further out of the money on the call side. That sell strangle trading just under $87, IV right around 57 or so. Fast forward to This is Thursday's close, right? Based on, where everything was at. We can see that now looking at the 280, 140, so 10 points further out of the money because the stock did go up to our comparison date, right? 207.55 to 212.60. So it's a stock about a 5 point higher stock comparison. So we moved the sell strangle comparison 10 points further out, right? But more importantly, only 655 days to go versus over 870 days back then. Much longer time frame and further out of the money on both sides, certainly, but getting a 3 point bigger net credit. Why? Because of IV. So kind of did the comparison, right? So the upside break even back in July, 356.90 on Thursday's close, 370 or so, simply because the implied volatility, right, jumped so much. So the upside break even, we got almost 8 points more upside break even, downside almost 18 points more, a little shorter delta wise, right? Not egregiously so, right? But here's the big thing, days expiration, 220 days less, right? So able to sell a strangle with a bigger cushion for a bigger credit with a lot less days to expiration. Why? Because IV jumped almost 11 and a half or slightly over vol points. So that got our interest peak. Fast forward to today's close, and we actually did the trade, right? So you can see that 140, 280 sell strangle now closed at $138. So that is certainly a huge move. So I did it from basically Monday, which was our, somewhat rich comparison to today. So that 140, 280 sell strangle on Monday was at 89.75, as you can see right here, right? Today it closed at 138. So it was up over 48 points. The stock did rise over 40 points, right? But the sell strangle actually increased 6 points almost more than the stock price, right? When the delta on it is somewhere around a negative 50. So you expect roughly about half the move, or about a 21-point move, instead over a 48-point move. Why? Because IV now has exploded another 14 vol points and is now over 83, right? So taking advantage again of this huge jump in implied volatility, right, on a stock that is getting hugely overbought and is hugely overvalued from a fundamental perspective. So that strangle we actually got into today. Here's the example trade we did, right? Able to sell it, did it just one time for the example for 130. Actually was a little too early. Did it with the stock at 245.72, but able to sell about an 82 IV, right? As you can see, 56 deltas net short by selling it. So we don't mind at all being net short the stock given the move on the stock price, right? And more importantly, we absolutely don't mind being short IV, right? Giving this huge run up in IV. So we're cautiously bearish the stock and absolutely bearish on IV. And anytime that you can sell a strangle that went up more than the stock price did, we're able to jump in and take advantage of that and do it that way. And we took a look at the theoreticals. Here's the close today on the call side, right? They were closed at about an 83 almost IV. As we said, they were priced at about $105. If we just drop that IV from 82.71 to 78, right? Not a huge drop, right? When you look at what happened with IV, right? We're just looking for a little pullback in IV, right? You can see that all of a sudden that call theoretical goes from 105, right, to under 100, or 5 points cheaper, simply because of a slight reversion in implied volatility. And let's say the stock goes up to 270, 15 more points, but vol comes in a little bit more down to 70, still very rich, right? When you take a look at IV here, as we said, this huge jump, right? We're not looking for it to even go back to here. We're looking for just to retrace a little bit of that. But you would have the call, even with the stock higher, if IV reverts, be cheaper, right? Same thing on the put side, right? Here's the puts, and if the IV reverts on the puts, right, by that, 3 or 4 vol points, you can see you'd pick up 2.5 points more. Obviously, if the stock rallies, those puts will get even cheaper. Plus, you have the ability to roll that short 140 put up if need be, right, to kind of further hedge the position if the stock continues to head dramatically higher. But also note too, by selling this sell strangle at around 130 like we sold it at, right, the downside, you only have 10 points of downside, right? Even if CAR in essence goes bankrupt, you only lose 10 bucks, and the odds of it going bankrupt are virtually zero. So you have virtually zero downside, and your upside, as we said, is well over $415. So you'd have to have the stock almost up another 150 points from here to get in trouble on that. Somewhere along the way, I'm thinking either IV reverts and or the stock price reverts. Either one of those will put this trade in serious profit category, as we said, simply doing our theoretical work with that IV reversion. So the ability to go long term, don't have to worry about timing it really, take advantage of the fact that implied volatility affects options in the long term more, selling a strangle that rose more than the stock price did on a day the stock price was up massively. This huge jump in implied volatility, as we said, able to jump in and just look for a reversion on that and or a reversion on the stock price. So hopefully provide some insight how we go about identifying opportunities here at Big Time Options. So until next time, here's the good trading, and we'll absolutely keep you updated on how this trade fares. So until next time, take